All right. Good morning, everybody. We still focused on FOMC tomorrow, but we do get the 10-year auction today. While we're not supposed to have favorites, I do tend to lean a little bit closer to the 10-year. It's going to come in at 2 o'clock. The auction time zones have changed a little bit. Used to be the auctions were 11, 11:30, and 1. Now we're seeing 1:30 and 2 more often. So that's just what's going on. It'll be 2 o'clock today. Um, Not really expecting too much out of it, but never know how it goes till we get there. There's been some talk about the Fed meeting, not just if we're going to cut, right? That's almost a done deal. The markets have priced it in. Everybody seems confident that they're going to get the cut. But the worry is the forward guidance after the cut. What comes next? And a lot of the writings that I've seen indicate the market is looking for a more hawkish Fed rhetoric and commentary. And how many cuts we're anticipating next year has been dialed back significantly. So the market isn't just focused on pricing in this rate cut. It's also focused on how many rate cuts are we anticipated to get over the next year. So when we go to the FedWatch tool, you can see how I got here. I just Googled FedWatch, went to the CME FedWatch group. We can see next year's FOMC meetings. And we can start clicking through those meetings to see what the market is doing when it comes to pricing in possible rate cuts and how many cuts we're looking to get. There was a nice article from Tasty Live that went into this. So if you got a little bit of time today, it wouldn't hurt to maybe take a look around, see some of the dot plot and projections for the next year to get a better idea of what the market is anticipating out of the Fed going forward. And this is very likely where the real fireworks are going to come in tomorrow. Not if we cut or not, because, like we said, that's pretty much baked in already, but what they're going to do in the next year. The projected tally for 2026 dropped to 52 basis points, and that's the lowest in 6 months. So that unwind, dialing it back to 52 basis points, was a part of the drawdown that we've seen since back here, right? Since October, and the drawdown that we had into November and then back up again. This can also get crippled even more if we get another government shutdown, right? That's really going to add some shenanigans. So you can see the U.S. markets are basically flat. Not a lot of love here. And it's not expected, right? We're not really expecting to do anything. We're in that hurry up and wait mode. And even with the warnings that I gave yesterday that, we could see an end to this pause because we paused for so long last week. We didn't get it, which is actually a good thing. We want to see the markets do the expected, not the unexpected. So holding the pause the way that they're supposed to hold the pause is a good thing. We have one more day of this. So if we hold the pause again today, then we'll be on schedule for tomorrow. And then we get the FOMC and we run it from there. So here's our 10-year note at 2 o'clock. And really, we don't have anything else on the other side of that today. It's later in the day than I would like. It kind of breaks our afternoon. So we got to stay on watch for this 10-year to be a big sea change into whatever we're doing in the afternoon session. And I wouldn't be surprised if we start to tighten up even more, say after 11 or after Europe closes, that we go into this micro range from Europe's close to the 2 o'clock auction, which will really suck. That's going to be a boring day. It's a good thing we can trade a lot of other things, right? Keep your eye on copper, crude, gold, even the Bitcoin futures can offer some opportunity. If we're just sitting in a little micro range, not doing anything, we got to find opportunity somewhere. Now, see, it still shows 1 o'clock on finance juice. And I checked this on the time frame multiple times. I think maybe FX Street is a little off because Finance Juice still says the 10-year is at 1 o'clock, and it's supposed to be at 1 o'clock. It's always been at 1 o'clock. That's just the way it is. So that's why we check multiple sources. Let's see if we can find it here as well. 10-year auction, 1 o'clock. You know what? I'm going to go with 1 o'clock and say that FX Street is just smoking something. That's good. That 2 o'clock auction really breaks the afternoon. So having it at 1 o'clock is much better. I like that. FX Street, I don't know. They got issues. We got multiple confirmations of a 1 o'clock auction for the 10-year. So we'll do that. Make sure we don't have anything coming out of the White House today. Yeah, tonight he's gonna deliver remarks at the Mount Airy Casino and Resort, but it's late tonight, so that's not going to be an issue. Well, I get that, but FX Street has been the go-to that we've used for years, and it used to always show those auctions at 1 o'clock. And then in the last 6 weeks or so, really since the government opened back up again, they've been showing odd hours for their auctions. It didn't used to be a discrepancy. Now it is constantly. All right, we're looking at Mentor Q CTA positioning in the S&P. and you can see that they are still holding above the zero line. So when we think about how much of their portfolio is allocated into the market, they are still allocated in. They reduced their holdings quite a bit, which makes sense. You know, things got really extended. It was a hot run. This has been one of the most hated bullish years that we've seen in a long time, with everybody sitting on the sidelines for various reasons and expecting it to go down at any moment, and it just kept running higher and higher and higher. That's all I heard from people this year, is how much money they were losing in hedges and getting out because they thought a run was over, and it just kept going. The only people that made money are the ones that just stayed in, broke every rule they had, and just kept running it higher. And that included me. I had to break the rules myself, but you know, it's just the way it goes sometimes. So they got too hot and they dialed things back, but they're still in. And this little bump to the upside in front of the FOMC really kind of highlights they're not too worried about things. That's for the S&P. We got the NASDAQ here, looks very similar. Crude, I mean, that's just a hot mess. They don't know what they want to do down here. It hasn't breached the lows, and we're not back at the highs. There's really nothing to see there. Gold, the previous allocation levels are clear, and when they get risk out, that's also really clear. It looks like they aborted their allocation on this run up, just like they did over here. They were starting to allocate back in and just called it quits. And it shows smart money, right? Smart money, my eye. Gold was breaking out and running, and this fits just what I was saying. Breaking every rule you got because something got too extended. It should have paused. It should have turned back. It should have mean reverted. So they got out, and it just kept right on going without them. That's been the story of the year right there. Markets going too far, too fast, and instead of mean reverting, it just kept right on going. Silver, they're still holding tight. They did get a little risk out, but not much. And if you look at the previous levels that they were running, even the yearly level from, April of last year, we're back above or back at that level. So yeah, they got out and it ran without them. Then they did a little chase to get back in, but they're not back in like they were even just a few months ago. And they missed a significant run in silver. Smart money. Just fun to beat them over the head with that, isn't it? And copper. Sure, they got out and it ran without them. Smart money. So I guess, one way to interpret all of that is, golly gee, if they can't nail it and you're new to trading and you're struggling because you think all of this is difficult, hey, they've got millions of dollars of analysts and tools and background and experience, and they can't get it right. Don't feel so bad if you're struggling and you can't get it right. Right. So, you know, a little bit of perspective. All right, this is CTA positioning in the S&P, just like what we were looking at from Mentor Q. But this is change to the positioning instead of the positioning itself. And if you really look at the changes that we've been seeing since, late August, we've been in this really tight range with those CTAs. They're just not doing much, right? A little bit in, a little bit out, a little bit in, a little bit out. They're kind of just holding, waiting. if you look back at the chart, it sure doesn't look like holding and waiting, right? CTA positioning. And this is the projection, what they should be doing. I don't know if it'll uh, catch it now. The last time I went to show you guys one and it went blank like this, it took a few minutes, but we never circled back to it to see it. This is the assumed average increase or decrease over the next 2 weeks. We'll circle back to it. Sometimes it takes a little bit to generate. Yeah, I'll have to digest that and circle back to this one. So NVIDIA got approved to sell chips in China, and China said, so what? We've already blacklisted those chips, and we don't want our companies to use them. And they did that a couple of months ago, right? China has started cracking down on businesses that could use NVIDIA chips and told businesses in China, you need to be using our chips, not chips made from NVIDIA. So the whole idea that, woohoo, yay, now we can sell chips to China, and China doesn't want the chips. Good times, huh? So we did hit the 111. You know, there's a phrase that says if we're going to reverse, it's likely to happen at the 111. That's what we did, but we didn't crash and burn, right? We're back to the one. We could pull back all the way to the 786 and still not be bearish. The reason for that logic is if you got a market that's in a trend and it pulls back, and then it's in a trend and it pulls back, and it's in a trend and it pulls back, those pullbacks are often the 786 level, right? So put that back onto what we're dealing with here. We had a nice run up, we pull back to a 786, then you get the next run up, right? If it pulled back and broke the 786, well, then we're no longer looking at that trend. We'd get back to the half back. And if that breaks, then we come back and challenge the lows. So at the moment, this is just a healthy pause. What kind of throws a wrench into the whole thing is we had the pause here. So if we were going to run up, pause, get a 786 pullback, and then continue to run, we already did the pullback. We should have continued the expansion into the next 1, 2, 3, 6. And we didn't do that. But we did get higher highs. So, you know, it might be sloppy and broken, forced grind higher, but it's not breaking down yet. Keep your eye on the 10-day. If we cut that, then we can get through the 20-day, then the 50-day, or, you know, use the marker levels 786 and half back. We are still flirting with the volatility trigger. We can see the 10-day here. Let's kind of clean this up a little bit. Wow. That'll do. Got the 10-day here. 68.32 cog line is really close to the 3-week moving average. Far below is the 20-day at 68.11 cog line. Got a spot gamma combo level down there. Round number. The 0 gamma level way down here in the 67.90 area. And then the 10-week. And somewhere far below, there it is. That's the put wall. I checked again this morning, not just looking at the lines, but the actual history of the call wall, put wall. I checked its charting and double checked the charting to make sure that we just wasn't missing the move in the call wall and the put wall, and we're not. They just haven't moved it. Overnight running at 68,000. It's a little above our half. It's not extreme. It's just showing a good amount of activity. Not that it accounted for much. We didn't really do anything. Maintained above the VWAP into Europe's open. Dipped below it and then got right back above it. Now we're looking at a little bit of a zipper program. What we get below, we expect to get above, and vice versa. That was a little shenanigan here. So we dipped down, ran it back up. We already got the gap closed from that little move, so there's really nothing much to do with it. The fun thing is, now that we have that candle, we can actually project out of that until we get into the RTH. Once we get into the RTH, we won't need to do any of this. But you know, if you're still trading this morning, that candle is now the only thing you need. You don't need the rest of the Globex. Break the half, come to the 786, get through that, get to 100, get through that, and run the 1, 2, 3, 6. On the other side of the show, get a 111. If we're going to reverse, it's likely to happen there. Otherwise, get into the 1, 2, 3, 6. That gets us back to the high. Then we can just run the whole thing. Globex high to Globex low. Good times, yeah. We don't really have much of an expectation of expansion today. Just like yesterday, we should still be in hurry up and wait mode. But because of the auction, we do have the opportunity to expand. That's just the way it is, right? That's what I thought. Gotta move that. This is the RTH of yesterday, so we can mark just the RTH and catch that half back. If we're looking for an inside day breakout, then of course we have to get all the way out of the entire day. But if we're just looking for, you know, levels to mark, then you can run just the RTH. And then of course we've got the full day. That's the real halfback. So we need to keep that. As long as we stay underneath it, we have the path forward that we can come down, check yesterday's low, and get yesterday's 111. Yesterday's 111 is one of my most profitable trades. It's called yesterday's 111, but it can be a 111 or it can be a 1, 2, 3, 6, right? Naming the strategy the 111 or the 1, 2, 3, 6 is just a little too much, right? So I just called it yesterday's 111, but you know, it can be either one. That goes for either side of the breakout. Whichever way we happen to break out of yesterday's range, I'll be looking for the reversal to come back in today. Because that's the expectation, right? That we hold the range for one more day and we have our FOMC. If that trade is wrong and we break out, I'm going to short it. If we break out, I'm going to flip it. So if we break down, I'm coming back up. And if we break out, I'm running short. If that trade loses and I'm wrong and it does continue to expand, so what? Because if we expand today after being compressed for so long, the expansion is going to be magnificent. The loss from taking the short will be easily recouped in going with the direction of the market for however much longer it wants to go in the direction of the breakout. So I don't care. Remember, trading isn't about never losing. It's just about making sure that your losses are small and your wins are bigger. So we don't want to spend all day trying to avoid the loss of possibly going the wrong direction on the breakout. Just have a plan to fix it. The ADR right now is 1.3. It's around $90. It continues to shrink, and every day that we're in this range, it's going to shrink a little bit more. Right? This is based on our average daily move. So if we go sideways for a week and a half, it's really going to tighten up our ADR. The problem is, at some point, we're going to expand and we're going to run right through this thing. this is more often seen with floor pivot issues than with the ADR, since floor pivots change radically on a day-to-day basis, whereas my ADR is normalized over a month. Still, it's very possible that these red lines are today's range. And if we expand beyond the red lines, then we've got the yellow lines. So whichever direction we go. Yesterday's 111 should get us right into those red lines. It certainly does on the upside. Hey, and on the downside. Really close, isn't it? It's really close. So it kind of highlights what I'm laying out there. So if we don't reverse on the 1, 2, 3, 6, the target is the yellow line in whichever direction we break. So if we go down and we get through the red line, aim for the yellow. And if we go up, if we get through the red line, aim for the yellow. That's simple enough, right? It's easy, easy. I like easy. That's what she said. Come on, someone was thinking it. Today's floor pivot is lower than yesterday's. That's bearish. Price opened within it, I'm going to say. And that just isn't bearish or bullish. I think we could possibly turn off the weekly channel, but we'll muddy through it. This is today's floor pivot 64, right? This line right here, that's today's floor pivot. This is yesterday's floor pivot. So today's is lower. On the week, we are now underneath the weekly pivot, but just barely. I mean, we're there, we're on the channel. We need to expand outside of the channel if we're going to really see anything to the downside. Now, I don't have weekly SNRs built in because I never use them. I would have to turn on another floor pivot indicator, set it to weekly, and then put SNRs on it. But it is worth questioning where the weekly SNR is if we do begin to get a breakdown. Here's the daily SNRs. 68.92 cog line for the upside, 68.32 cog line for the downside. They're a little tighter than my ADRs, but they'll work. The S1 is right on yesterday's low. It's almost fantastic. And R1 is almost perfectly on yesterday's high. That's rare to get them both lined up like that, but hey, we'll take it. So it's possible we see something like we did on Friday, where we just tag an R level and then drop. That could be, tagging R1 instead of R2 or bouncing off of S1. But usually when we get there, we make it through and then, give it up afterwards. There was a first touch play on Friday. It's another really good example of tagging one of these SNR levels. Tagged it, dropped, and then made another run at it and tagged the second one and dropped. So if we get outside of the weekly channel on the floor pivot, aim for yesterday's low to the downside, and that'll be an S1. And if we get out of the top side, then, aim for yesterday's high, and that would be R1. The SNR levels for the week, as I mentioned, it'd be a really good idea to know where those are at. 68.20 on the downside, 69.20 on the upside. I'm rounding a little bit, but you get the idea. Okay. We're nowhere near that level yet. All right, we are back into last week's distribution. We're just continuing the build out of the previous week. Got a lot of structure against that 6850 zone that really expands over a 2.5 week period. It's not hard to see that if we break 6811 cog line, 6750 is back on the table. I'd like to say if we get back under 6850, but we've been up and down around that 6850, and it hasn't been so cut and dried as that. So 6800 is too low. 6832 seems to be like right on the channel border. So that leaves us with 6811 cog line. We drop underneath 6811 cog line, I'm going to aim for 6750. $67.50 is also the 50-period daily moving average. It's not quite the half back. Unless we're running it from the previous. So always a question when it comes to analysis, where do we snap the line? This was what we were running earlier because that's what we were using, right? Then we came down and we tested it and it held and we came back up again. So this is still a valid drawing. Of course, you could also do what I had originally done today, is run it from the other direction. This would still be valid. So either one. The thing about the measurement that we have here is we can see that the halfback has already been broken. There's no first touch plays or any trust or trade setup from getting back to the half in any way. It just is a visual or perspective on where is the halfback. That's it. And that's why we would use both. That gives us our half. Then we just come over and use this one to show us the current right now half. This one would very likely have a more responsive trigger if we were to get back down there. If we go for 6750, it's completely possible that we overshoot it as well because the speed bump is around 6720. But we've been running 50s and I still like 50s, and that's what I would anticipate is 50s. Come on, Thinkorswim. You can do it. I'll give you a cookie. 10-day, 30-minute volume profile and TPO. We're still holding in the channel, and I don't know, it seems like it's been a while since we've had a 10-day value area that was so narrow as this. This is massive concentration against the top of the zone. It's fantastic. Obviously, we're not going to see that point of control move anytime soon. It's going to take a week before we even get to these candles and start removing them from the board. We need to GTFO and get out of this value area. To the downside, 6720 stands out really well, even on this time frame. You know, we had it out there on the weekly, and it was perhaps a little hard to see. It's very easy to see here. This value area stands out as the next spot. So we're talking about, you know, an air pocket of risk dropping down because there's nothing really to hold us up. That tiny little speed bump right there, I don't think that's going to bother anything. You know, it's like throwing a Pepsi can in front of a car. It's just going to run it over. So I don't think that's going to be anything. and there's nothing at 67.50 itself. So I think if we get to 67.50, we just straight up overshoot that level and we end up around 67.20-ish. To the upside, 69.50 because we're running 50s. And then past that, we'd be looking for 70.50. Because why not, right? All right, we got a point of control sticking out today. It's not a VPOC because we've already hit it, but wow, I don't even have any. I'm gonna say let's grab a line and set it up, but I don't have any to grab. So we'll just put one in place here. The textbooks, when it comes to these volume profiles and TPO profiles, the textbooks say carry these lines forward from yesterday into today's trading session, regardless on whether or not they've been hit. Look, I've got enough pivot points that I don't need more pivots just on GP, right? Just bringing them forward just on general principle just doesn't work for me. So I only carry forward this point of control, and typically I only do it if it has not been hit. It's already been hit. So I don't want to label it as a VPOC. V stands for virgin. It would be a virgin point of control if it has not been touched. Hey, I don't name these things, right? That's not on me. But it's not a VPOC, it's just a POC because it has already been touched. It's been hit. $68.45 is the POC from yesterday. We tagged it and it held. It is very likely representing a lot of trade activity. So if we get back down into that spot, expect that again. I don't want to call these support or resistance because we don't know if they're support or resistance, right? If it was overhead, possibly we would consider it might be resistance. Underneath us, it might be support, but we don't know that. What we can say without adding any bias at all is that that's where the greatest amount of trading took place yesterday. And that if we go back down there today, we can anticipate elevated trading volume again today if we were to go back down there. Looking at the way the market moved down into that drop, it looks like buyers stepped in and tried to turn it all around, right? And run it back up. It certainly matches what we saw in the overnight when we dipped down there and tagged that level. How many more times are they going to step in and play save a hoe before they just get out of the way and let it drop and buy it at a cheaper level? So keep your eye on 68.45. It's not a surprise, right? 68.42 is an old school cog line. 68.50 is the options level, and 68.32 is a cog line. So that whole zone has digits and levels. On the week, we are still in hurry up and wait mode. We haven't done anything. We're still sitting inside of yesterday's range, which for the most part stayed inside of Friday's range. And we are at the moment still inside of Friday's range. Friday being that blue bar here, then Monday, and then today. So we're about to drop back outside of Friday's low. 68.57. Let's just round up a tick. But then we would just still be sitting inside this previous range that we've been dealing with, right? And you could argue that this range is still intact anyways, and that was just a 111 or a 1236 fill. That sucked. If we measure the entire range and do what the textbooks say, which is set 50%, that's our 50% right there. So there's just a lot of history here. It's a lot to fight through. If we get underneath Friday's low, we got to cut Monday's low, which is really close to Thursday's low, right? That's what we bounced on yesterday is Thursday's low. Then we got to start worrying about triggering stops that would be there, there, all those, right? We haven't done anything, so we're still 0.32% above the 10-day. It's basically, I like to say, about 0.25% above the 10-day. We're fine. That's the zone. It's where we want to be. We're not overbought, not overextended. We haven't moved too far, too fast, and it doesn't owe us any sort of pullback or mean reversion. But we knew that because we haven't gone anywhere or done anything in over a week. Speaking of the week, on the weekly, we're still above the 10-week 1.3%, call it 1.25 for some easy numbers. The trend that we've been seeing with these lower highs still in play. So until that breaks, we're not looking for a sea change or a significant change in market dynamics. It's just still the same game we've been playing. With FOMC this week, we know that the indexes are likely going to stay sideways. So we want to shop around. If you're playing in equities, then you've got something to play, right? There's always something in equities. But if you're not doing that, then if your futures, like I mentioned earlier, maybe take a look at commodities, Bitcoin. There's always something to trade. China's down and uranium is down. That's not much. Looking at what's up, the VIX, gold miners, Mag 7 down volume is up, not by much. And really, that's it. We got nothing, right? A whole lot of nothing. Silver, gold miners, some ag. Yeah, I mean, they've been talking a lot about agriculture in the last few days. China's supposed to be stepping in. Farmers are a little salty. Can't say I blame them. I live in Kansas. So yeah, think a farmer if you see one. Nothing. If we're going to get a breakout in a rally day, the stuff that we have this morning isn't going to do it, up or down. We're going to need the Mag 7 to step up or a change in the dollar yields, something. We got nothing, right? Looking at the broader market, this is the NASDAQ, and the white line is cumulative volume index on the NASDAQ. Well, you can see when the market's topped out, right? When I kind of zoom out, that's the NASDAQ topping out up here. Look at that white line. It's not like they dumped their holdings. So net volume, net buying volume, still dominant. Little bit of weakness, a little bit right there. Then we just continued the drive to the upside. So, a little bit of perspective on what's going on with the indexes. That doesn't look bearish to me. Nope. If you can search for cumulative volume index on Thinkorswim or, IBKR, TradingView, whatever, it's just an indicator. Net buying, net selling. A JGB 10-year is starting to curl over just a little bit. The thing is, it could just do what it did here, curl over for a day or two, three, and then just continue the expansion. Or it can finally reverse maybe sharply with velocity like it did back here in late March and into April. You guys remember April, don't you? That was fun. All right, puts are getting bought just a little bit, and the price of those puts are starting to increase, but just by a tiny amount. Not extreme like it was, say, back in April. You can always use known events. This is how bad it could be. This is where we are now. When we put it into context, doesn't really seem like much, but everything starts small and then snowballs. So a small change in the VIX structure and the cost of protection. Not much. Price rallied back up after that drop this morning, but cumulative delta did not. So positioning stayed out. You can see how price rebounded off of that low and ran back up again, but positioning is still at that low. A little bit of a divergence there. Look for a breakdown in the CD for a nice short this morning back to, say, 68.50 or even back to 68.42 old school cog line. And if you get that close to yesterday's low, might as well look for an overshoot into 68.32 cog line, which would be a 111 of yesterday. And that's my play. Otherwise, look for the divergence to go the other direction, right? If the CD starts to pick up, then we know we're not going to see the ES catch down. All right, all things considered, we got a relatively easy day. The expectation is that we stay inside of yesterday's range, and if we do break yesterday's range, play the 111 or the 1236. We're not expecting any expansion today to actually hold and continue the breakout. One of the reasons is we're in positive gamma. When we're in positive gamma and we break to the upside, they will sell into strength. If we break to the downside, they will buy into weakness. That's what they do when we're in a positive environment like this. If we were to get below the gamma line, then they would sell into selling and they would buy into buying. So even the dealers are going to be trying to play this reversal off the lows and run it back in again. Who are we to fight the dealers, right? And that's if we can even get to the edge of the range. Expect as we get closer to 1 o'clock that we go into some tightness even more. So after 11, or more specifically after Europe closes, look for a micro range to begin from Europe's close to the 1 o'clock auction. So I got for you guys. Be careful, be safe, keep your eye on the clock. I'll see y'all tomorrow.